All right, welcome everyone. Let's go ahead and get started. My name is Brooke Wilson. I'm one of the account managers at Beehive. I'm going to be helping with fielding questions and getting us started today. On the line, we also have Laurie. She's going to be presenting our topic today, where we will talk about the type of coverage that needs to be offered and more information on the penalties. So we'll go ahead and get started, and I'll turn the time over to Laurie.
Thanks, Brooke. So we're glad to have everybody here with us. We're glad for everybody who has been attending our webinars previously. If you have not been able to attend those, you can view those recordings. They are currently online at our Go-To Stage channel. You can see our first two recordings are available. They are live. You can watch them right now. We are still editing those transcripts, so it might misinterpret some of the acronyms we're saying, but they are available right there, so you can currently watch them and they are available to use. We are also getting those uploaded to our Beehive Insurance blog shortly. So we're working on all of that, getting everything ready to go for you. So again, as always, please ask any questions. We know that some of the content today is stuff that we don't always deal with when we're addressing the Affordable Care Act. So please ask your questions in the comment section so that we can address those and make sure that everybody has the best understanding that they can of the Affordable Care Act and how it applies to you as an employer. We have added this great big disclaimer, just mostly as a reminder to me to make sure to mention that this is not legal or tax advice. We may have errors in what we are saying or teaching, and that this is a generalization of the Affordable Care Act. So we do at Beehive Insurance have some wonderful, incredible resources for licensed attorneys, HR professionals, and so much more. So if you need detailed advice or specific things, we also have an amazing partner when we're talking about the penalties, that if you as a company receive a penalty letter from the IRS, we have some amazing partners that can help guide you through that process if you have any questions about it. So that's our big disclaimer for today. Today we are going to be talking about quality coverage, affordability, and the penalties. So this is our third part of the webinar. We have previously discussed who is an applicable large employer in our first section and who is an eligible employee in our second webinar. So we're glad to have our third part. We'll be spending most of our time on affordability and the penalties, but let's get started. So as always, we're going to start with our summary of the employer mandate, where large companies have to offer quality coverage that is affordable to 95% of eligible employees or more, or pay a penalty. So again, we've gone through a lot of these before. We have large companies are those who are an applicable large employer, and they have 50 full-time equivalents. And eligible employees are employees who average 30 or more hours per week. So today we're going to jump into more details about quality, affordability, and the penalties, which is some of the big ticket items that we really want to know and understand as employers, to also help any HR managers so that we can help guide those who are making the decisions when we are setting different costs, making decisions on what plans to offer and who we're offering them to. So this is one of the key parts in knowing what we need to do in regards to the Affordable Care Act to make sure that we're making the best decision, not only for the employees, but for the company as well. So we have our acronyms for today. First, of course, is the Affordable Care Act, or ACA. We also have an acronym, the Employer Shared Responsibility Payment, ESRP. We don't use this acronym in our webinar, but we find that it is important for you to know what the penalty is formally called and formally addressed as, so that you can, if you are looking into doing more research on your own, it's the Employer Shared Responsibility Payment, or ESRP. We also have MEC for minimum essential coverage. Unlike other acronyms, we do just generally say MEC instead of MEC. It's easier, and it's the way we've ended up doing things. We have MV for minimum value. And then when it comes to affordability, we are going to be using the FPL for federal poverty level and ROP for rate of pay. So those are the acronyms we're going to be using today in our webinar as we are discussing affordability, quality coverage, and the penalties that may be assessed if you do need to comply with the Affordable Care Act. So when we're talking about quality coverage, we need to first ask what is coverage under the Affordable Care Act. So the Affordable Care Act does not govern coverage such as dental coverage, vision coverage, accident, hospital confinement, standalone telehealth, critical illness, disability. Those are not health coverage and are not governed by the Affordable Care Act. So we are looking strictly at medical coverage for the Affordable Care Act. Any of the other things, if you offer them, they're great. We hope you are able to offer a full suite of employee benefits. But when it comes to the ACA, we only really care about medical coverage. So there are two types of medical coverage. There are minimum value plans, and there are minimum essential coverage for MEC plans. Minimum value plans cover the 10 essential health benefits, and they cover at least 60% of the actuarial cost of the plan. A MEC plan is any insurance plan that meets ACA requirements for having health coverage. And I know that is super specific, but that is basically the minimum requirements for a MEC plan, is it meets ACA requirements. Generally, that means some preventive care. That's about it. They may cover other expenses. They usually do. If you are looking at the ACA marketplace, you will see catastrophic plans. Those are not minimum value plans. They are minimum essential coverage plans because they do not cover at least 60% of the actuarial cost of the plan. So you will see catastrophic plans that do cover the 10 essential health benefits, but they are not that 60% minimum bar to be a minimum value plan. So those are technically minimum essential coverage plans. Also keep in mind, minimum value plans are all considered MEC. So that will come into play when we do the penalty section, that all minimum value plans are considered at least MEC because they are better. It's like saying 100% is always larger than 5%. So how do you know if the plan you are offering or the plan you have is minimum value or MEC? Simply, you will know if it's a MEC plan. It will be clearly labeled. Very few of our clients do offer MEC, but they do have a purpose, and they can be a benefit to your company to offer and consider a MEC plan. But a vast majority of the plans that we are quoting and that you are offering as employers, they are minimum value. So if you don't know, there's a 99% chance that it's minimum value that you're offering. You will know if it's MEC. Minimum value plans, if you are on the marketplace, they will also be labeled as bronze, silver, gold, and platinum. That's an easy way to know if it's minimum value. And of course, you can always ask your account manager. So that is quality coverage. Quality coverage is minimum value. If you are offering a minimum value plan, you are technically offering quality coverage according to the ACA. So now we go into the next section of what is affordable coverage. So as we're jumping into affordable coverage, we also need to look and recognize that there are lots of different costs. So when we're talking about affordability, we're obviously talking about the cost, but which cost must be affordable? Because we have the full monthly cost, we have what the employer is paying, and we have what the employee is paying, and then we have all the different coverage levels. So the only coverage level that we are concerned about as an employer with the ACA is the employee-only responsibility or employee-only coverage level. So in this chart, it would be that $175 per month. So that is the only cost we're concerned about. We are not concerned about considering affordability if they have a spouse or children or family on a plan, only for the employee-only coverage level. And of course, we're looking at the employee's monthly responsibility. So now we need to figure out, how do we know if that $175 is affordable? Well, the IRS is the one who gets to determine what is affordable, and it is considered affordable if the employee's portion of the employee-only coverage, that $175, is less than about 9.5% of their household income. Keep in mind, we're using about because that 9.5% changes every year. It wiggles just a little bit. However, there is a problem when we're using household income, because as an employer, you cannot know an employee's total household income. An employee may have a second job. They may have student loans that they're paying, and the interest may be considered not part of their household income. There may be alimony and other factors to consider. So you can't know an employee's household income. And because of that, the IRS has given you some safe harbors that are considered affordable. And there are 3 available safe harbors that you can choose from, or you can, of course, choose to go with none and hope that it is less than 9.5% of their household income. But we definitely prefer if you use a safe harbor. So the available safe harbors are the federal poverty level safe harbor, the rate of pay safe harbor, and the W-2 safe harbor. So let's go through each of these safe harbors and how to calculate them and approximately what they're equal to. So first off, we have the federal poverty level safe harbor. It is usually around $94 to $100 per month for employee-only coverage. So if your employee-only coverage costs your employee less than $94 to $100 per month, you may be able to use the federal poverty level safe harbor. The way it is calculated is you take last year's federal poverty level, divide by 12 months, and then you multiply by the affordability percentage for that year. So let's get a little chart of what the affordability percentage is for each year and the federal poverty level for each year. So you can see, as we've gone on in years, in 2016, we started out down at the bottom of this chart. We had a 9.66. It went up in 2017 to a slightly higher percentage, down in 2018, and now we're back up in 2019 and down again in 2020. So this affordability percentage does change, but for our examples, we will be using 9.5% because that is what the affordability percentage was originally set as when the Affordable Care Act was introduced. And we do use the federal poverty level from the previous year. And again, this federal poverty level is the level for a single person household. It does not account for any children or spouses or dependents. So when we put our affordability percentage and our federal poverty level, here is the safe harbor amount we get for each year. So for this year, if your employee-only costs less than or equal to $101.79, then you can use the federal poverty level safe harbor. If it costs more than that, then you cannot use the federal poverty level safe harbor. So you can see how it has changed throughout the years. And right now it seems to be rising just a little bit each year. So that is our federal poverty level safe harbor. It is ideally our preferred safe harbor, but it is expensive as an employer. The next safe harbor we have available is the rate of pay safe harbor. Keep in mind, when using the rate of pay safe harbor, you must use the lowest paid eligible employee's rate of pay in any given month, or use the lowest annual salary if your employees are salaried. So we have two calculations for this, one for hourly employees, and we have one for salaried employees. The one for hourly employees, those who are paid on an hour-to-hour basis, is we take the base rate of pay multiplied by 130 hours for the month, and then by the affordability percentage for that year. Keep in mind that the base rate of pay cannot include any tips, bonuses, commissions, or things of that nature. It is the base rate of pay. So if you are paying employees, their base rate of pay is, say, $4 an hour because they are waiters and waitresses, this can be a hard safe harbor to make. For salaried employees, you will take the base annual salary. Again, we are not including bonuses and commissions, dividing by 12 to get the monthly salary, and then multiplying by the affordability percentage. So because hourly rates of pay are slightly more common, we're going to get a little chart to show what the rate of pay safe harbor ends up being with different hourly rates of pay. So for all of this, we're going to use an affordability percentage of 9.5% just for these calculations. Again, keep in mind that the affordability percentage does change every year, and currently it was, I believe, 9.78% for 2020. We would have to check on the previous slide to see what it is, but 9.5 ends up being a pretty decent estimate. So looking on this chart, if your lowest eligible employee is paid $10 per hour, then your employee-only coverage would need to cost $123.50 or less in a month in order to use the rate of pay safe harbor. One issue we have encountered is if you pay employees different amounts for different tasks. So if you have employees who generally get paid, say, $20 per hour in a month, but each month they have 2 hours where they perhaps attend a company meeting, and they're only paid $10 an hour for those hours that they're at the company meeting, then their pay for that month is going to be $10 an hour when using the rate of pay safe harbor. So keep that in mind when you are using the rate of pay safe harbor. You are also using the lowest rate of pay that that employee has in that month. Even if they're working that month and they work 200 hours at $20 an hour and 2 hours at $10 an hour, their rate of pay for that month is considered to be $10 per hour. So you can see how this can be a slightly more forgiving safe harbor than the rate of pay safe harbor because it is larger. You as the employer would not have to contribute as much towards benefits, but you do have to use the base rate of pay and base annual salary. So if your employees are paid more, you may be able to increase or decrease what you contribute towards benefits. So this may be a recommendation that we may give you to say, hey, we noticed that some of your employees are only making $15 an hour, but if you paid them $17 an hour, you could use the rate of pay safe harbor and know that it's affordable, all at the cost of just giving 1 or 2 employees a $1 or $2 raise. So we may make recommendations like that to increase your employee's rate of pay so that you as an employer don't have to pay as much towards benefits. The last safe harbor we have available is the W-2 safe harbor. And we don't recommend depending on it. It has some major pitfalls, but as you've seen, the other safe harbors also do have their downsides. So the W-2 safe harbor is using the amount in box 2 of an employee's W-2 as their household income for a year. So again, remember that you're only using the W-2 you have access to. not W-2s from outside employers or anything like that. You're only using one W-2. The way it is calculated is you take the amount in box 2, you divide by the number of months employed, and then multiply by the percentage. The hard part is that number of months employed is rounded up. So if you have an employee who works 1 day in January, it is rounded up, and that is 1 month. Also, if you have an employee who is hired on January 30th and they leave your company on March 1st, even though they only worked for you for 30 days, because they worked in January, February, and March, that is 3 months. So that is the really hard part with the W-2 safe harbor. So let's do a couple of examples for the W-2 safe harbor. The first example, we have an employee who is hired on February 15th, and they are eligible for benefits beginning April 1st. This is a waiting period, first of the month, after or coinciding with 30 days. A reasonable waiting period. They work full-time, 40 hours per week, the entire year at $12 an hour. The amount for this employee in box 2 is going to be nearly $22,000. Because they were employed February through December, they were employed 11 months out of the year. And for this example, we're going to use the percentage of 9.5%. So in this case, if this was the lowest calculation you got, you could use a W-2 safe harbor if your cost was $189.86 or less. But we need to do this we would need to do this calculation for every employee that you are planning on using the W-2 safe harbor with to ensure that this is the lowest W-2 safe harbor option right here. So let's look at another example of how this could change. So we have another employee. They've been working for your company for a while, but they were termed early in the year on January 7th. They worked 8 hours per day for only about 5 days, and again at $12 an hour. Because they were employed during January 7th, they were eligible the entire month of January. So that 8 hours per day for $12 an hour, their box 2 for the year is only going to be about $480. But they were considered employed for the entire month because, again, we're going to be rounding up. Again, using the same affordability percentage of 9.5%, and keep in mind that does change every single year. If you had this employee, your cost, your employee-only cost for employee-only coverage would have to be $45.60 or less in order to use the W-2 safe harbor. So that is the major downfall of the W-2 safe harbor and makes it hard to use because you don't know what's going to be in those box 2 until the end of the year. So we don't recommend the W-2 safe harbor, but it may come in handy if you aren't able to use the other 2. We can check and see if you are able to use the W-2 safe harbor. So here are our side-by-side pros and cons, mostly cons on this slide. So with the federal poverty level safe harbor, the employer costs are going to be highest, but you have a guaranteed amount that you know is going to be fairly consistent year to year of what you as an employer need to contribute towards benefits, that your employee only cost needs to be less than about $100 per month. If you are using the rate of pay safe harbor, the hard part is that you can only use the hourly rate of pay, the base hourly rate of pay, or salary. You have to use the lowest one. You cannot include any bonuses, commissions, or tips. And if your employee is hourly, you could only use 130 hours per month. Even if your employee is working 170 hours per month or 200 hours per month, you can only use 130 hours per month for your calculation. If you're using the W-2 safe harbor, It is difficult to use if you have employees who leave in January or are fired in January. It is also difficult for employees who are hired on the 30th and termed on the 1st of a month, because again, we are rounding up on all of our months. If you work one day in the month, it is considered that they worked the whole month. Also, when using the W-2 safe harbor, FMLA cannot be excluded from the number of months employed. So you could have an employee who worked all 12 months, and we're using 12 months for our calculation, but they only had 9 months of income due to FMLA. So it cannot be excluded from the number of months employed. So those are some of the hard parts of using each of these safe harbors. You can use multiple. So any safe harbor, if you are using, it must be applied consistently among employees in a category. And some of those categories are going to include your specified job categories, specifically the EEO1 categories. You can use different safe harbors if your employees have a different method of compensation, for example, salary versus hourly, and if they have a significantly different geographic location. So if you have one employee working in Salt Lake and another in St. George, you may be able to use or attempt to use different safe harbors for different employees in different areas. And also, similar bona fide business criteria is another category you can split your employees up into. So you can use multiple safe harbors, but again, they must be applied consistently, and each employee in that category must be eligible for that safe harbor. But what if you can't use a safe harbor? You get to the end of the year and you realize that your coverage was too expensive for the W-2 safe harbor and the rate of pay safe harbor. You look at your employees' W-2s and you find out you can't use that one either. In that case, you run the risk of a penalty. And the IRS is going to need to look at your employees, what coverage they were offered, the cost of the coverage, which is entered on the information that you submit to the IRS on your forms at the end of the year when you are filing. And the IRS will determine if it was affordable or not for that employee. So ideally, you want to use a safe harbor, because if you don't know if your coverage was affordable, and you don't know if you're going to be receiving a penalty until it comes. So ideally, you want to use a safe harbor. We do recommend primarily the federal poverty level and rate of pay safe harbors to use. So that is a good thing when you are setting your employee costs, that you take a moment to look at what especially your new hire employees, what they are being paid full time as, to ensure that they're being paid enough and you're not hiring somebody who is going to make it so you can't use a safe harbor. So now we get to the fun part of how much are the penalties. So now we get to the easiest way to look at this is this flow chart for each of the penalties to figure out which penalty may apply. So the first question that you ask yourself, again, we're remembering that large employers need to offer quality coverage that is affordable to 95% or more of eligible employees or face a penalty. So we ask the first question, did you offer coverage that was at least met to 95% of your eligible employees? If the answer is no, and we hope it's not, we hope your answer is yes. But if the answer is no, you would be facing penalty A. And I know it says 4980HA. We're just going to call them penalty A and penalty B. But those are the formal names for the penalties. Penalty A is big and scary. You do not want to be facing penalty A. You can see in our bottom right box right here, the penalties are calculated by taking an amount and multiplying by a type of employee. So penalty A is multiplied by all of your eligible employees minus 30. That 30 is the grace amount of employees that the IRS gives you that you can subtract for penalty A. The next question, so if you answer yes and say, yes, we did offer at least MEC coverage. So that is the purpose of offering MEC, is to avoid having to face penalty A. You offer MEC, you get to say yes. Now we say, did any eligible employee, so this goes back to our second webinar, where we mentioned that there were situations where you're offering good enough coverage. So now we need to look, was there an eligible employee who was not offered coverage because they went from part-time to full-time or full-time to part-time? Something weird happened and they just got missed. Did any of those receive a subsidy? And we're also noticing that these three questions all lead to the same endpoint. So we can also ask, is the coverage minimum value, and is the coverage offered affordable? Were you able to use a safe harbor, or did the IRS find out that the coverage you offered actually wasn't affordable? So depending on your answer to the question, you'll be facing the lesser of penalty A or penalty B. So if you end up offering coverage, your penalty will always be less than somebody who didn't offer coverage. Keep in mind that when calculating these penalties, if you do offer them, hopefully you go through this flow chart and you see, I don't have a penalty and everything's fine and dandy. But this penalty amount does change every year. It is currently close to $2,500 and $3,750 for the different penalties. And again, remember that penalty A is the big scary one because you're taking all of your eligible employees and only subtracting 30. Penalty B, while the penalty amount, that $3,750, is larger than the $2,500, the number of eligible employees you have that receive a subsidy is going to be very small usually. Probably only, say, 2 to 4% of your eligible employees instead of all of your eligible employees. So if you have 100 eligible employees, penalty A would take that amount multiplied by 70, because you're taking your 100 minus 30, and penalty B would be this amount multiplied by maybe 3 or 4 employees. So penalty B is a lot smaller due to the second part of the calculation. So again, when looking at our penalties, remember that the amount of the penalty changes year to year. The penalty amounts we're going to be using in our examples are from 2019, where the penalty A was $2,500 and penalty B was $3,750. At least one employee must go to the marketplace and receive a subsidy for either penalty to apply, because it needs to be there for penalty A, and penalty B is calculated only based on employees who receive a subsidy. Penalty B is applied for each eligible employee who received a subsidy. And again, because few people receive a subsidy, penalty B is often much, much, much smaller than penalty A. So let's also, one more thing is that these are the yearly amounts for the penalties. Each penalty is looked at and applied on a monthly basis. So if you have 1 month where you're out of compliance, for example, maybe you find out that your employee was making too little and you suddenly, you say, all right, next month we are going to give them a raise so we can use that rate of pay safe harbor. You would only receive a penalty for 1 month. So you would take the penalty amount and divide by 12 for each month. As we're going through our examples, we're going to use our examples on a yearly basis for our calculations, but keep in mind that they are applied on a monthly basis and they are prorated for each month. So let's go through our first example. In our example, in 2019, the travel company didn't offer coverage to any employees for the whole year because they have lots of part-time employees and they didn't know that they were an ALE. So let's look at what their penalty could be. So first, let's look at the number of eligible employees and how many received a subsidy, because again, remember, at least one person must receive a subsidy in order for any penalty to apply. So they have, in 2019, they had 35 eligible employees and 2 received a subsidy. Also note that when we are saying eligible employees, we are meaning employees who are eligible for coverage based on any hours they have worked, or if they were hired to be full-time and look like a duck. This does not include employees who were in a waiting period or a measurement period and were ineligible for coverage during that month. So this does not count a lot of your new hires for each month. But again, for this example, we're going to be calculating it as if they had 35 eligible employees the entire year and 2 received a subsidy the entire year, all 12 months. Now we ask 2 of our penalty questions. Was an offer made to 95% or more of eligible employees? And was the coverage affordable and minimum value? Because coverage was not offered at all, of course, there was no coverage to be affordable. So now let's look at our penalties. We have penalty A and penalty B. Penalty A is for not offering coverage. So penalty A does apply. And the penalty amount, because this is 2019, we're going to use the 2019 penalty amount, which just happens to be a nice round number. I wonder if that's why we chose it for our examples. So our penalty amount is going to be $2,500. We're going to take our number of eligible employees, which is 35, and we're going to subtract the grace number of employees, which is 30. That 30 is consistent and does not change year to year. And our end penalty ends up being $12,500. For sake of argument, we're going to look at what penalty B could have been if they had offered MEC coverage. It currently does not apply, but if they had offered MEC coverage, we would take, and because it would not be minimum value, penalty B would be a factor. We're taking the $3,750 and multiplying by the 2 eligible employees who received a subsidy. So penalty B could have been $7,500, but because we didn't offer coverage at all, they get the first penalty, which is more. So that is the benefit of offering a MEC plan, is it changes which penalty you could be facing. Our next example, let's go through an unaffordable one. So in 2019, Pictures Inc. couldn't use a safe harbor because they had eligible employees who were making minimum wage, and their coverage cost $150 per month. With coverage that costs $150 per month, their employees should have been making at least about $12 an hour, but they had some who were making minimum wage. And because those employees also didn't have a high enough household income for it to be affordable, they encountered some penalties at Pictures Inc. So let's look through our same questions. We have our eligible employees and how many received a subsidy. So at Pictures Inc., we have 50 eligible employees and 3 received a subsidy. Now we're going to ask our penalty questions. Was an offer made to 95% or more of eligible employees? And was the coverage affordable and minimum value? So they did offer coverage, but it was not affordable. So now we get to look at our penalties for Pictures Inc. And again, our examples are done on a yearly basis. If Pictures Inc. in February or March had recognized that they had eligible employees making minimum wage and that they wouldn't have been able to use the rate of pay safe harbor, they could have given those employees a raise and only faced the penalties for a portion of the year instead of the entire year. But in our example, they didn't, so they get a penalty for the entire year. So let's look at our penalty chart. First, let's look at penalty A. Does it apply? Maybe. We're going to pick the lesser of the two penalties because, again, penalty B, if you offer coverage, you will never pay more than somebody who didn't offer coverage. So let's calculate out penalty A and see if it ends up being smaller than penalty B. So penalty A, again, we're going to do our $2,500. We're going to multiply by our 50 eligible employees, and we're going to subtract the allowed grace number of employees, which is 30. So if penalty A is smaller, it would be $50,000 for the year. So this is why you definitely want to offer some type of coverage because you want to avoid penalty A. So now we look at penalty B. Again, does it apply? We're going to pick the smallest of the two penalties. So to calculate penalty B, we're going to take the penalty amount for the year, which is $3,750 in 2019. And we're going to multiply by the number of eligible employees who received a subsidy, which is 3. And penalty B ends up being $11,000 and $11,250. And it is definitely smaller than $50,000. So this is why you want to offer some type of coverage, if at all possible, so that you offer to at least 95%. Looking back on our good enough example, again, we mentioned at the end of the previous webinar that sometimes it is easier to not offer coverage to a variable hour employee as long as you are still offering affordable quality coverage to at least 95%. So here we have an employer who offered coverage. It was affordable, it was quality, and it was offered to 96% of their eligible employees. However, of that 4% of those eligible employees, one of them wasn't offered coverage and received a subsidy from the marketplace. So this employer has 50 eligible employees and one received a subsidy. And no offer of coverage was made to this one employee. We still get to answer yes to our other penalty questions of was an offer made to at least 95% and was coverage affordable and minimum value. Because no offer of coverage was made to this one employee, we may encounter a penalty. So let's calculate what our penalties are. Again, we're going to pick the smallest of the two penalties. So our calculation for the first penalty, penalty A, is going to be $2,500 multiplied by our 50 eligible employees, subtracting our 30 for our grace amount. And again, this is $50,000 for this employer. But again, we're going to pick the smallest. So of penalty B, we're going to multiply $3,750 by the number of eligible employees who were not offered coverage that received a subsidy. So that one employee. And the cost for the year, the penalty, is $3,750. I really like multiplying things by 1. It's a great number. Because it's the smallest, that would be the penalty. And you may notice that if you were to divide that by 12, it would be about $300. So the cost for not offering that employee coverage per month ended up being about $300. The cost to offer that employee coverage and have them enroll would probably also be a little bit more than $300. So as an employer, the penalty in this case ended up being less than the actual cost of offering coverage. So that's why we call it good enough. So you may receive a penalty, but you may find that the penalty was actually less than what would have happened if you had offered coverage. So those are the penalties. And again, they are applied on a per month basis. So if this particular employee only worked for you for 1 month, you would divide penalty B by 12, and that would be what your penalty would be for the year. So those are the penalties. Also, we're going to keep in mind that the IRS so far has been about 2 to 3 years behind in applying penalties. So right now we are seeing employers receive their penalty amounts for 2017 and 2018. So the reason for going through this part of the webinar is to let you know that, that as those are coming in, this is how those penalties are being applied. And you as an employer can look and say, did I offer coverage? Did I offer coverage that was affordable? Did I use a safe harbor? Was it minimum value? And you can look and understand where that penalty amount is coming from. So last, we're going to answer the question of what if you don't file because you didn't know you were an ALE, something else happened. Applicable large employers are required to file the forms. However, the failure to file timely or correctly is the same as the penalty that would be if you were to fail to file your W-2s in a timely or correctly manner. So it can be $15 to $50 per form, up to about $250 per form. So you really want to file. But you will also recognize that that is the penalty for not filing is on a per form basis. So there are some ALEs who are not required to report. And those are ones that had generally no eligible employees throughout the year. So if your entire workforce is all part-time people who absolutely never work more than 130 hours per month, you may not be required to file. But ideally, you are aware ahead of time if you are an applicable large employer because you have attended these webinars, and you are aware if you have eligible employees and need to file. So we do recommend filing. And again, this can be done through Employee Navigator, which will be in our next webinar on Thursday. And we do hope that you're able to join us then to go over some of the features that Employee Navigator has. So we'll have some extra time for questions. We have finished a little bit early, not quite as early as our previous webinars, but this content we find is important. You can view our previous webinars. They will be added to the Beehive Insurance blog, but they are currently on our Go-To Stage channel. And that's also where you can register for upcoming webinars. And that is also where you will see our upcoming webinars for our client conference that we are doing digitally this year. Those will be up there hopefully this week or next. So keep an eye out there, and you can register for our next webinar on Thursday at the Go-To Stage link. So these webinars have been recorded. And again, they are not legal or tax advice. You can please ask us questions, get in touch with your account manager if you have specific questions so that we can help you through the process of penalties or determining and ensuring that your coverage is affordable. And if you have received a penalty that you don't fully understand, again, we have some excellent contacts who have helped previous clients through the process and helped them navigate things with the IRS to ensure that the penalty is accurate and as small as it can be. So that is our webinar for today. Thanks for joining. And again, you can find these webinars online and they will be available. We'll have this webinar uploaded shortly so that it will be available for you to go back and look at. You also have in your handout section the quick guide, which does have a quick summary of the penalties and how they are calculated. And we're glad to have you here. We hope you're able to join us again on Thursday.